What an earnings call once again for Tesla. I mean, seriously, if you look into the numbers, there are some amazing things going on top and underneath the surface. It's just simply amazing. You guys know I'm not a pumper, so you know I'm not blowing smoke up your rear. They really were great. But I have to ask, is Wall Street setting up to screw Tesla? Well, I'll give you the reasons why they may try and why I actually love that they may try to do that to Tesla. So make sure you like the video and subscribe to this channel if you like the truth without the hype. And check out the Market Insider's private group as the 420 sale in honor of Tesla's earnings date ends this weekend, so you see our next Tesla buy that we make. And for reference, our last Tesla buy at $700 just over a month ago is really looking sweet right now. So if you want those alerts plus 4 free courses, live weekly Q&As, exclusive videos, and a ton more, check out the pinned comment. What? Yesterday was April 20th when Tesla reported, 420, so I don't know what you guys are talking about. So Tesla blew away expectations, beating on both the top and bottom lines, and not just by a little bit, but by a lot. And I mean, seriously, you don't know how key that is in this type of market. I got several DMs from folks in my group last night upset that despite these incredible numbers, Tesla only got a 5% bump or so after hours. My counter to that was very simple. In this type of market, just a plain earnings beat is going to send a stock lower by like 5% or so. And an earnings miss means destruction like Netflix got. I mean, it was down 35% the day after. I have never seen that level of destruction in such a large company, or I guess I should say used to be a large company. And that's after a 20% plus destruction it got the day after earnings last quarter. That is the type of market we are in right now. Instead of a miss being a 10 to 15% pullback like normal, it is being greeted with a 35% walloping. I'm sorry, it's not 2020 anymore when you saw stocks fly up 20% on great earnings. The time will come for those types of moves, but it's not in this type of market right now. So let's take a look at the number I found most interesting, and I'm not going to belabor them all just to stretch the video out and stuff at full ads. I think everybody basically beat me to it all last night, so there's a lot of great deep dives from several creators out there for those that are interested. But Tesla had 30% margins without EV credits in a car company that manufactures cars. Imagine that number if they had sold a normal amount of X's and S's too. They still haven't really ramped those back up yet either. And remember, those margins are without the regulatory credits, so bringing those up is just a waste of time at this stage. And I'm not even sure Gordon Johnson, hold on, I'm sure he will probably say it, but outside of him, it's not really a discussion anymore. I don't think people really understand how amazing this margin growth is. They're getting tech-like margins and a factory-driven business. It doesn't matter if other automakers actually compete in terms of having some vehicles to buy. This is a margin none of them can touch or even come remotely close to. I don't care what anybody says, they can't do it. And keep in mind, this was all done during a high inflationary environment where many of the items needed to produce the cars and just higher cost overall, some of which will go down, meaning margins will go up by default if they don't change a thing. Oh, and it happened with the factories not operating at maximum efficiency, and the newer factories, the batteries and other innovations just now coming online will increase those margins even more. Just think about how juicy the entire balance sheet will look when the new factories get ramped up and are bringing money instead of costing money. It's just crazy and quite honestly ridiculous at this stage. But I think Wall Street will still try to take a dump on Tesla eventually, and there are 2 main reasons for that. So let's jump into reason number 1, and that would be Wall Street is still not sold on Tesla itself, or Elon, or both really. Like it or not everyone is sold on where Tesla is going, what they are trying to accomplish, and what it will do for their share price ultimately. And you also have many large investors that just do not like Elon and his antics and would prefer a more buttoned-up approach to running a company. Just look at his recent Twitter dispute to see an example of what institutional investors hate. Now, I personally love it, and we'll cover the Twitter drama in depth along with ARK's price prediction and a couple other Tesla and Elon related items in a video coming shortly. But we all know Tesla would not be where it is at if Elon was not being Elon and, being Elon. But this will continue to be a sore spot for those guys for now. And the second reason why Wall Street will try to screw with Tesla stock again is because a recession may be coming, and even if it doesn't, a slowdown at least is coming, and that usually hits the auto industry hard. Now don't go yelling at me, this isn't me saying it. But for now, many view Tesla as a car company, and we cannot just dismiss this position altogether when the cars make up the vast majority of their revenue. Clearly, they are better than everyone else and next level on all kinds of things, but when dealing with Wall Street, they look very macro in times like this. And the prevailing wisdom is that car manufacturers get crushed during a recession or a slowdown, if I could say the word recession. They get crushed during a recession or a slowdown, and you bet your bottom dollar they will look to try and punish Tesla, at least in the short term. And this should excite you if you are a long-term investor. Tesla is executing incredibly, and you can still buy shares at these prices and potentially even lower if Wall Street gets stupid yet again. And this is the exact scenario every long-term investor wants with every stock they want to own long-term. And that would be an extended time of incredible performance by the company, but the stock price stays flat or down. Then you have more time to add more shares. It happens all the time, and the longer it goes, the bigger the slingshot is when it finally runs. And it will eventually run, and then you have more shares than you would have had if it had just run up earlier, and then people will FOMO into the stock because it came out of nowhere just like Tesla did in 2020. The reality is, Tesla didn't come out of nowhere, and those that bought in 2017, 2018, or even earlier than that saw signs all over the place that it was going to be a beast at some point, and they got the benefit of that rubber band being pulled kind of so tight that not only did Tesla run, but it ran up big, and if they were adding that whole time that they owned, they also had far more shares than they normally would, which is how you make more money than you should as an investor. It also illustrates exactly why I don't trade. I just buy and hold and take advantage every time Wall Street gets stupid and sends Tesla back down to my buy price target. Then I get to take advantage of those huge run-ups with even more shares. And if you don't know how to get a price target or analyze Tesla stock and you want a step-by-step process to do that and much more, don't forget to lock in your discounted membership price using the link in the description or the pinned comment to join the group. And if you don't know what stocks to consider buying, click this video right here for 9 stocks I've been buying like crazy, or click this video here for even more stocks I've been buying lately. So thanks for watching, and we'll see you in the next one.